Hi, today we'll be going over some accounting information on the basics of accounting and also some principles of accounting. And I'm going to talk about what accounting is first of all and give you a little bit of explanation on the basics of accounting. So let's get started. Accounting is the way of journalizing your financial information in a chronological order, but also you have to know and make sure that you record, summarize, and classify information. Actually, if you look at the order, it's recording, classifying, and then writing it out or summarizing that information in a chronological order. We do this because we need to account for our revenue and expenses and also reconcile our accounts. So in order to understand accounting, you first have to understand the accounting equation. That's the first and foremost important task that we need to know, that what is the accounting equation. So I am going to write it out. The accounting equation is assets is equals to your liabilities plus owner's equity. Your assets is equals to your liabilities plus owner's equity. Your assets are basically, they are such as land, land, building, prepaid supplies, prepaid advertising, supplies, account receivable, prepaid rent. All of these are your assets, and there are other assets as well. Just to add another one, notes receivable is going to be your asset as well. All the receivables are your assets, and your liabilities are the amount that you owe, or it's an obligation, a debt, or amount that you owe that include notes payable, accounts payable. They are the most common. Accounts payable is the most common. All the payables are your liabilities. That's the amount that you owe. Assets are, that build your portfolio, that add to your wealth, your worthiness. And liabilities they are the debt. It's the debt. It's the obligation that you owe. You have to pay it off. On the other hand, your equity, your owner's equity, the third portion of this is, what is equity? Equity is something that you have that contributes towards your capital. Equity is also your capital. Your capital. You invested, an example that I would give is, you invested $90,000 in the business. So that $90,000 that you invested in the business, that $90,000 cash goes towards cash, which is your asset. So you're going to add cash, which is the most liquid asset. This is the most liquid asset. What is liquidity? The most liquidity is how much do you have on hand? So that is your liquidity. That is most liquid. That comes first. Account receivable is another liquid asset. And your capital goes to your equity. So owner's equity, the other thing, 90,000, going back to the question, would be going towards your owner's equity. So 90,000 cash, assets, 90,000 equity, which will be your capital. And that is equals to your equation. Assets is equals to your equity. So based on this, we will build on our concepts today and talk about more about this equation and list other things which basically are included in the equity portion of it. Equity also includes revenue. So the accounting equation continues: assets equals to liabilities plus owner's equity plus revenue minus expenses, REV, revenue minus expenses, EXP. I'm abbreviating here, but I'm sure we can figure it out. Revenue minus expenses, that is also part of the equation. Revenue is inflow of money, all the money streaming in. Your expenses, on the other hand, are your disbursements, any payments, money that is going out, that is your expense. Money that is coming in, that's your income, that is your revenue. For a business, you have to understand, for a business, the lifeline is what? Is cash, is revenue. If the revenue is coming in, the business will strive, it will do well, it will be successful. And if your expenses are curtailed and you match your revenue with your expenses, that gives you what? It will give you a net income or a net loss. You want to always have the net income. Why? Because you want to make money, right? As a business, your goal is to maximize your wealth. Your business should do well, so you should have an income. Now, does that happen in the real world? Yes. Sometimes no, because if your expenses are higher than your income, you will have a loss. And that's where you have to make sure that you watch carefully that what you are spending and what you are earning. And that gives you the net income or net loss. A very important aspect in accounting. And knowing this fundamental accounting equation, this is known as your fundamental accounting equation. This is your fundamental accounting equation. So, based on this information, we move on to the next steps, and we further, dissect the equity portion, where we have something called contributed capital, common stock, and dividends. Contributed capital has common stock and dividends. That is basically a part of the equation where we have to understand what a common stock is. First of all, what is a stock? A stock is just a piece of paper, but it has a face value. It has some monetary value, and that is traded on the stock exchange. Owning a stock, there are two types of stock. First of all, you have common stock, and then you have a preferred stock. And these two types of stocks represent different types of ownership. Obviously, when you have an IPO, which is initial public offering, you have initial public offering IPO in the market for Facebook, for example, which was years ago. They float shares in the market, and you buy those stocks. Those stocks are the common stock that are announced through an IPO. The other type of stocks are preferred stock, which is kind of RSVP concept. It is not open to the public, and it is always by invitation. It's by invitation only. You get invited to buy stock. Warren Buffett asks you to buy his stocks. That's by invitation. So it's so important to understand the contributed capital equation on that part, what common stock and your dividends are. A little bit on stocks here. We will dive into more detail in other accounting lectures as we move forward. But in order to understand common stock, here's an explanation. And also your dividends are it's form of a payment that is given to shareholders. It's given to shareholders. It's like a reward given by the company to shareholders in form of cash dividends, or sometimes they offer you more shares as well. So your dividends mostly are in form of cash, or they can give you other offers to buy more shares in form of dividends. But dividends, for example, would be and a good example to know is REI. It's a sporting utilities company. They have a great program which is basically in form of dividends. How much you spend per year, you get back after a year in form of dividends, and they mail you a physical check. It comes in your mail, and that's your dividends for the year. Based on how much you have spent, they reward you. It's like a cashback program. They reward you on your spending and how well the company has done overall. So this is a little bit information that we have that I'm passing it on as far as the fundamental accounting equation is concerned. You have revenue, you have expenses, assets is equals to liabilities plus owner's equity plus revenue minus expenses, and then common stock and dividends are also a part of this equation, which comes under the contributed capital. I will, as we move forward, I will give you a little bit more information on the rules of debits and credit, and tell you about how debit and credits are performed in accounting. Because accounting, you have two entries. We use double entry accounting system. One is a debit, and the other one is a credit. So let's talk a little bit about debits and credits, and also give you a little bit of insight on what debits and credits are. So I will move here and try to utilize this space and tell you a little bit about debits and credits. Your left-hand side is of your, this is a T account. This is a T account in form of a T. So your left-hand side will have a positive balance. Your right-hand side on the cash will have a negative balance. This is what? This is your assets. Your assets, your cash is an asset. Accounts payable is a liability. So your liability would be accounts payable. Liabilities are minus and plus. Left-hand side must equal right-hand side. And this is negative, this is positive. Cash, assets, left-hand side positive, right-hand side negative. Liability, left-hand side negative, right-hand side positive. Owner's equity, as you will see, will have, sorry, I was just referring to one of my lecture notes. So the owner's equity on the left-hand side always has revenue. Should have revenue and expenses. Revenue goes down on the left-hand side and goes up on the right-hand side. Expenses, actually it's the other way around. We'll try to incorporate this. Revenue increases and left-hand side and decreases right-hand side. Expenses, on the other hand, go up on the left-hand side. Actually, expenses go up on the left-hand side and go down on the right-hand side. And revenue goes down on the left-hand side and goes up on the right-hand side. I was correct initially. So owner's equity is negative and positive, and that owner's equity has two portions. One is revenue, the other one is expenses. So you have to understand the basics of the fundamentals of the debits and credit. Your left-hand side is debit. Your right-hand side is a credit. So left-hand side debit, right-hand side credit. Assets left-hand side go up, the right-hand side go down. Liability left-hand side go down, right-hand side go up. Owner's equity goes down, goes up on the right-hand side. Then you have revenues. Revenue goes up on the left and goes down on the left, goes up on the right. Expenses increases on the left-hand side and decreases on the right-hand side. So this is the fundamental accounting framework of your T accounts. We use the double entry accounting system. The double entry accounting system is where you have one debit and one credit. You have one debit and one credit. To balance the left-hand side and the right-hand side, to make it equal, we use the double entry accounting system, of which is the basics and the most important step to understand your debit and credit, is to balance your left-hand side with the right-hand side. Moving on, based on this information, we will talk a little bit on my second video. I will let you know a little bit more information on the financial statements. I will cover that and tell you what are financial statements, what are the most important financial statements, and why do we use financial statements in accounting, so that all this information will build on that. And hope you enjoy this, you understand this, and take advantage of this information that I've passed on today. Hope to see you again soon. Look out for my other video on the financial statements part of the accounting, which will involve three main important financial statements: your income statement, owner's equity, and balance sheet. Thank you for watching. Have a great day. Thank you. Bye.